Hello and welcome back. This is David from the Personal Finance Squad. We just finished off section 8.5, what we saw happen to Jasper if he chooses to miss payments. Not only can the late charges accumulate, but the interest rate can be bumped up to a very high number, and we saw how badly the impact can really be on the interest that is accumulating and of course taxing the budget to be able to pay the credit card off. Okay, so what we need to get into now is paying off multiple cards. It is very common for 2 or 3 cards to be in each household that are charging interest. By household, it can be, that means individuals, it's married couples, partners, whatever it may be. That's how that number is derived. That's what it means. And in my case, I'm going to say we have 10. Now, we don't pay interest on any of those 10, and I'm not even sure why we have 10, but we do. Now, the other thing is, there could be people with 10 out there, and they have interest charging on all of them. So again, it all varies, but the whole point of being able to pay the cards down, the formulas to do that are the same. So the last thing you think that you'd want to do is to get another card to help you out. So there are cards out there, though, that are low interest rate, or in a lot of cases, you can, especially on the time, like right now, this is 2016, there's lots of zero interest credit offers out there for a period of time. And that's what we're going to look at below here in a second. And right here we're saying they can go as low as 0. And again, it might just depend how the market is and how many customers they want to reel in. So let's say you're paying 20% on a card, and you can pay 5% for an introductory period, then it's a wise thing to do that. Certainly if you can get 0, you would take it. So what I've done here is you're going to see like this little grid, and this is how a grid would read in some shape or form on a card if you're given an offer that you'll see in the mail quite often, or the fine print online. Somewhere you're going to see this kind of language. So you see credit level, excellent credit, which means generally 700 or plus score, and the purchase APR is like the kind of the terms, and so is the transfer information. The purchase APR says of any new purchases. So it reads 0% intro APR until this block of time. And what I've thrown in here is just kind of some rates. So really what it is just to let you see that they could see variable amounts of rates. This is just an example, right? What they're typically going to do, they're going to have one rate in here, what they're talking about. And then this is variable APR after that. This APR will vary with the market based on prime rate. And we'll get into that in a second. Variable APR again. Transfer information. This is balance transfer. This is the part that we're talking about. This is having the multiple cards, and depending on the credit limit you get, you want to transfer as much of that money as you can in order to put it down to a 0 rate or a lower rate. And it says the same, has the same information in here, right? And then there's an annual fee in this case. So now this part here is pretty common, that anything that you transfer over, going to cost 3% of that balance total. And we'll show an example in a second about showing that detailed out. So you can see here that you get a lower rate, you should try for it. And when we say 700 plus credit score, that shouldn't be a deterrent if you're somebody trying to do this. But of course, the better credit you have, as usual, the better rates you'll get or the better offers you're going to receive that are out there. So again, we just said in this example that you need excellent credit to get the offer. We're just going to assume that Jasper, in this case, has excellent credit. Oftentimes, the introductory time period, the time period where you pay the low interest or the 0 interest in this case, is 6 to 18 months. But again, that can vary as well. I've seen cards out there that are 21, 22 months, especially at this moment in time. And then understand the future interest rate may be higher than the current interest rate, and that is the variable part we're talking about. And we talked about the balance transfer fee. So, for example, we see here that we're going to, actually, let me break this out a little bit. Okay, so we say, for example, Jasper has 2 cards, and he has one at $6,500 at 17 APR and $8,200 at 18% APR, and has a total current balance of $14,700. So, we're going to say that the credit limit is good enough, and it has enough of a ceiling for him to actually transfer these 2 cards over. And we're going to mark this 3% balance transfer fee into the total from the total balance here, right? And that creates these charges and these charges come up to $441. So when he transfers his balance, it's going to be $14,700 plus the $441, and that brings him his new total right here of $15,141. So now the next step is to come up with a payment plan based on the credit card issuer's terms, which will be 0% for 18 months. After the 18 months, the credit is still in excellent standing, so that means payments were made on time. Then the lowest rate will be 13% based on APR, and that has to do with some of this jargon up here. Okay, so what it means here for the APR is it's a rate that banks charge to their most credit-worthy customers. And the rate's pretty consistent between the major banks. And if the rate is adjusted, then the banks make the change at the same time. So they all follow together. So these rates are often seen in not just credit card loans, but there's personal loans, autos, other financing types, right, that's pegged to it. So there's a graph out there which I've went and pulled up. And you can find these anywhere if you were interested. And so this prime rate is tacked on to an APR rate, and that's what a lot of banks do. So that's what the fine print said up there. It said 9.5% APR plus prime. Okay, so what this means is after the 18th month, it's going to become a variable rate. So 18th month complete, then variable. So again, it's 9.5 as we wrote up there, plus, now we need to go look at the chart here. Now you can see, for example, with the prime rate that this goes back all the way to 2006, so it's quite a long graph. Now generally the prime rate movements are very slight, and look how flat this was for almost a couple years. And then when I talk about economic factors, right in here, like this little slope down here, up to 2009 in that area, that's during the financial crisis. And 2009 was pretty much the bottom. And then since that point, the rate has stayed flat for many years here, 7 years, and just went up in 2016. The Fed itself did not raise interest rates for this entire period, which means pretty much there was no interest rate out there at all. So now in terms of prime, the prime rate was at 3. So right now it looks like it might be like at 3.5. So if we did this today, that would be 3.5%. And then it equals 13%, which is what was up here for this particular credit card offer. Now, the thing to understand is that the prime rate is based off a monthly rate. So that means your 9.5 is always fixed. But the prime rate can change. So even though it may change slightly, it's still a change. So it looks like in here, if I recall, this is about a 1/4 point. So let's just say it goes up another 1/4 point in another month. So it's 9.5 plus 3.75, and then the new rate would be 13.25. So this is how prime rates work. They worked on certainly they work on other, especially mortgages with ARMs, adjustable rate mortgages, and that's exactly what they mean, adjustable rate. So we'll get into that a little later. I just wanted you to see what prime was because you're going to hear it depending on the loan type that you get. So we were just talking about this here. My example pretty much is what is covering here, right? It just gives you a little bit more information. Like the prime rate is shown in the Wall Street Journal on the 25th day of each month, so we know the consistency of that. Now in this case, in this term, the variable rates, the following segments will be updated quarterly and take effect on the first day of January. So in this case, maybe I misspoke here. I've had loans in the past where they adjusted monthly, but you see January, April, July, and October billing cycle, so the quarter. So in this case, the way this reads, here's our 9.5, and this is the program that we're looking at for Jasper. Then we know that once we hit for the new rate, it's going to stay there for the quarter, so for 3 months. So this is what we were saying up here with this example, that in the example above, receiving 13% is a stable assumption based on the trend of prime rate due to its history of minimal fluctuations in small periods of time. So what I'm saying here is that Interest rates have not gone up at all, but they just went up recently. And again, the way the market conditions are, the way the talk is out there, that more than likely the trend is that the rates are going to start to go up, not down or stay flat. So therefore, if you're a bank, you're thinking, okay, I'm going to get the 3.5, and I think it's only going to go up from there. And if this person keeps paying on a card, then I'm going to keep making more money on top of just the rate that I'm getting today. So that's a risk-adverse type of way to perform their business so they can put more money in their pockets, and that is their right to do so. Okay, so we're going to say after the 0% period, the rate is, we only know the rate is at 9.5%. We don't know what the prime rate's going to be in 18 months. So now we need to understand the new payment during the introductory period. So we know that there's $15,141 that Jasper's going to transfer. And he knows that actually it's not an entire year, it's 18 months. We've changed that. The next premise is to consolidate the credit cards, right? And usually the premise is that an interest rate in the future will be less than the interest rate from previous cards, which we are obtaining. So then the plan there is to look at the minimum payments of the last month of the previous credit cards. And that's the number that will establish what is being afforded. So what we're saying here is, at current state, Jasper's paying this much and this much, these two amounts on the current credit cards he has today. And that number comes to $447.42. So we're saying here, listen, he can afford this. He's already doing it, so he should be able to commit no matter what at 0% interest. So I went ahead and did a little calculation here, and we find out the new minimum payment based on a 0% actually is $454.23. So it's such a small difference, we're going to just assume that he's going to go ahead and make that payment. Now, of course, with the 0% interest, the beauty is that there's no interest. So every dollar you put on there just means I can just crank, and just get that credit card knocked down. So put together a little chart here or two to look at and see what the effects are. This is the scenario here where Jasper, his first payment is $454.23 that he can commit to, but the minimum payment's going to go down, of course, because the balance goes down. And again, we always talk about this trap about only making the minimum payment. If he can afford this, he should pay this all the way through here and knock these out. But you can see the cycle. Look how much the balance has gone down between just 4 months because of the amount that he is paying. So now, this is the other way of looking at it. If he just made the minimum payment through the 18th month cycle, his balance at the end of that would be $9,021.40. And look how much smaller the minimum payment is at this point. It's quite a big difference there. Now we say, you know what? He's going to pay this $454.23 every month. So after the 18th month, now the balance is $7,419, and that is a huge difference. Minimum payment stays the same. So we can see here that after the 18th month, with this number and paying $453 instead of the minimum payment, that the difference between the two scenarios is $1,602.21, and that is a 51% reduction. So again, he's able to afford it. He should continue to do that, and the reasons are clear as why he should do that. So what I wanted to do here is just throw another frame of reference in here, but let's say Jasper just wanted to throw in another $100 on top of it. He found money somewhere else. So instead of paying $454.23, he's going to pay $554.23, and that reduces the balance to $57.19. Just in 18 months from a $15,000 balance. It's amazing if you are disciplined what it can do, just as an inverse what it can do to add up if you miss payments and the rate goes up. So that is very nice there. And that is a 62% decrease in 18 months, a year and a half. If he keeps that trend up, balance will be knocked out in 2 years. Now 2 years seems like a long time, but the amount of money it took to get there and going the old path and by just making minimum payments would be several months. And so again, this is the value of getting these cards at lower interest or 0% interest if you can do that. So keep the cycle up, keep paying, and find ways to do that and be disciplined to put more money in there. And then the other thing I want to point out is if when that interest rate period is done, so the 0% after 18 months expires, go get another card if you can do it. If they want to give the business out to you, then you should go for it. Because really what that card cost to get was $447.42, as we have right here. So was it worth it to pay that $447.2? You betcha. The amount of interest that adds up the other way doesn't even compare. So this is the value of getting lower rate interest cards. Now you can see the pattern fall into place as to why you should perform this exercise. No matter what way or how you get the money, do it, because it's the only way to go. And if you can't get a card, the other thing you have to do, which we can see a little bit later, it's obvious we've been saying the entire time, is that you have to find ways to cut expenses and draw more money out of that budget and into your cards. Because, again, cards don't provide any value. And there's actually people out there that have 401ks that they're committing to every month and paying credit card interest at the same time. And in these scenarios with people that I've seen, they're paying more in credit card interest than they're making an interest on their 401ks, which is completely counterproductive. So you have to think about these things, about where your money is going, and that the importance of, again, getting rid of the credit cards. Okay, so we're going to stop here, and then we're going to get into our next section in the next video, which is 8.7. That is paying credit cards down without having the ability for an introductory rate. And that's what I was just getting at. You can't get a card, you still need to pay it down. How are we going to manage this? Okay, so thanks for joining, and we will see you in the next video.